Welcome. Good morning. As we get started, we would love to just have you answer a quick poll, which is, do you believe taxes will go up in the future? Yes, no, maybe, or you're not sure.
Good morning. While we're
we'll
waiting,
get started here in just 1 minute.
Yeah, good morning. While we're waiting for that poll, I just wanted, this is Bob Meath, I wanted to kind of start out with a couple examples of why we think retirement planning is so important. And one is a client we were referred to, a local well-known artist in actually this January. And he was 68 and she was 70. And she had started Social Security at age 62. So she'd been taking her benefit from age 62 until the present time. And he's still working, and he's 68, and he was going to wait till age 70 to take his Social Security. So in our first meeting, I just asked him, "Are you taking the spousal benefit on your wife's Social Security?" Because at age 66, you could have signed up and taken the spousal benefit on her benefit, and then wait till age 70, and then you can turn yours on, and then she could either take your half of yours rather, or stay with hers depending upon which one's higher. But he was not aware of that. So, it's basically about a $550 a month addition to their income when they did go turn it on. So they have turned it on now. Another example is when you look at retirement time and you look at your plans, this is an example of somebody who has $500,000 in their 401k plan. And we always think it's important to look at these dollars, the money that you have in your IRAs, kind of what's your after-tax net worth. As you can see, the way that you take it out, in what tax bracket you take it out in, really makes a big difference in how much money you actually can spend. The example we have here is, in a 35% tax bracket, it's $325,000. If it's a 37, obviously it's 315. You can just do the math. But so it's not so much the size of the account, it's what's the after-tax worth. And you can do a lot to control that by either leveling income or taking more money out of a retirement plan in a year that maybe your income's down for some reason. Maybe you funded a donor advised fund, but there's different ways you can control your income. And then that also becomes a good year to take additional amounts out of your IRAs, because managing the taxes at this time of your life is critical.
So you're obviously serious about setting up your portfolio and taxes for retirement, and we just want to take some time to acknowledge you for that. Most people never take the time to educate themselves the way that you are. You're online, you're watching this course, you're listening to our voices, and you really have the commitment and the determination to do this now for yourself. That's why you're perfect for understanding how taxes impact your retirement. This course is designed specifically for people like you who want to be prepared for retirement, make sure they're covering their bases, their risks, and their taxes. This is what we do, and we're really serious about helping you live better in retirement. Good morning. This is Taxes in Retirement 567, and we are going to be your presenters for today's course.
Yeah, let me introduce ourselves a little bit. We're both from Meath Wealth Advisors. My name is Bob Meath. Founded the firm over 30 years ago, and have had the opportunity to speak nationally many times on these kinds of topics. With me today is my daughter, actually Carrie Meath-Sinkin, and she is my daughter. She's a certified financial planner and an accredited investment fiduciary. Prior to joining our firm, she was a consultant to wealth management firms in the Washington, D.C. area. And before that, she graduated from Brown University with honors and worked as a consultant, as I said, for wealth management firms. She also has a master's in public health from the University of Texas and a graduate degree from the Ayurvedic School Institute in Albuquerque, New Mexico. Just because she's my daughter, I can also say that she was also a nationally ranked tennis player when she was in college.
Okay, so as we jump in here, just a few housekeeping items to be aware of. We typically run these seminars in person. And so one thing that's great about that is that we can stick around afterwards and answer questions. We won't have that opportunity with you today, but we assure you we want to address all of your questions and concerns. So what we'd like you to do is to take some notes or answer questions through this. You can drop those chats in the chat box labeled Q&A on the right-hand side. And we are the only ones who will be able to see those, so you don't have to worry about other people looking at those. And again, that panel is on the right-hand side of the screen. And in that panel, you'll see those Q&A. And we'll try to get to some of those questions. We're going to do our best to answer all of those, but we're also going to call each one of you within a couple of hours after our webinar today to go over any outstanding questions or concerns, and to schedule part 2, which is the individual education session, where we can go more in depth for you. During that meeting, we'll also give you a personal social security analysis, which can, might add articulated to that at the beginning today. Next to the Q&A, you'll also see some labeled handouts. These handouts are available. You can click on them, you can download them. They cover the Secure Act, the Tax Cuts and Jobs Act, and they go through the 4 stages of retirement. And we're going to talk about those more together at the end today. And then periodically, you'll see throughout the webinar just a pop-up slide across the screen. If you do want to schedule that part 2 now, you just click on that, get it scheduled. To close that out, all you have to do is click on the small X in the upper right-hand side. Okay, let's jump in. Our presentation today is going to be broken up into 3 parts. During part 1, we will go through your key retirement risks. During part 2, we will discuss tax-efficient distributions and hidden penalties during retirement and how those affect you. And then finally, in part 3, we will bring it together, discuss those planning through the 4 stages of retirement in more detail, talk about the Tax Cuts and Jobs Act and the Secure Act. And as we said before, our objective today really is education for you. There's a lot going on as you approach retirement, and we want to help you understand it better. Just a quick note, we are not tax professionals. We're wealth advisors and financial planners, and what we do is help people understand how the tax code and rules could impact their financial planning and investments. And then we develop a plan that takes that into account. But we always recommend that you consult with your own qualified tax professional on your specific situation. So as we look at things, as we said, our goal today is to help you understand how the retirement game changes. And it's much different than the accumulation game when you're saving for retirement. Chances are you've been in the accumulation phase for several decades, and you've been working hard to try to save money and prepare yourself for retirement. But now as you enter or prepare retirement, you're in an entirely different phase, the distribution phase. And that distribution phase has new, strange rules that can catch people off guard. And along with those new rules, there are many changes in your personal life that can have a big impact on your taxes. For instance, your children may be grown, which means no more child tax credits. Your house may be fully paid off, which means no more mortgage interest deductions. If you're already retired, you may no longer be receiving tax-free employer-paid medical insurance. And if you stop working, you no longer have the ability to put money into your 401k or a similar plan to manage that annual tax bill. At some point, you'll also start taking Social Security, and sooner or later, when you reach 72, you'll have to start taking required minimum distributions, and the list goes on. Many aspects of the retirement, will affect your tax bill in totally different ways than during your working years, and understanding what those are and how they impact you is really critical. So before we jump in, we just want to take a minute to address the different stages of retirement. And again, the ages on these vary, but there are some broad components to keep in mind. The first is the pre-retirement or the final work and save years, ages 50 to 60. Next, you have the early retirement years, 60 to 70, sometimes called the go-go years. This is extending out and moving into the 70s as well. Traveling, volunteering, new hobbies. This is really when you're doing a lot out in the world. Next, you reach the middle years of retirement, 70 to 80 plus, which is more the go slow years, which brings more financial decisions, such as how to deal with required minimum distributions from your IRAs and retirement accounts. And then finally, there's the later years, when your health may not be as good and you really want to understand your legacy and estate. And that starts, 80 plus, really depending on your health. So as you see, there's a wide range of issues that must be planned for in each phase, and there's a lot of components that you want to keep in mind. So that brings us to part 1, which is addressing those retirement risks.
Yeah, we wanted to show...
and before we jump into that, just a question for you. What do you think your biggest retirement risk is? inflation, longevity, healthcare, stock market risk, or public policy risk.
As we wait for that, I think this slide here really addresses what we think is the kind of the roadmap for a successful retirement, and it's based upon a goal-based planning retirement plan. But as you look on the left-hand side, you'll see that the first thing you obviously want to do is determine what your financial goals are. You know, what your income needs will be in retirement. That's kind of a benchmark place to start. So that's what kind of retirement income do you think we'll need? Along with that, then you put your contingency expenses. But contingency, what we mean here is, are there additional travel expenses you want to have? Is there charitable giving that is in your plans? Is there a second home that you're looking for? But you can put a number on those things. Then there's also the legacy goals, and that may be, 529 plans for your grandkids, a certain amount left in your estate for either your kids, your grandchildren, or a charity. But those are all goals that many times we have our clients, they can put a number on them, and then we can forecast that out and help them address if these things are possible. And if it's not, we can do some what ifs. What if we change this? What if we change that? But along with that, it's really important. It's critical to also look at addressing those retirement risks. And those are in the middle, because those are things that we don't know when they're going to happen or if they're going to happen, but they could happen. And you want to make sure that you have a plan to address those. We have them listed. We'll talk about each in a little bit more detail. I'll just put them out there. Longevity, inflation, healthcare, long-term care, sequence return risk, stock market risk, public policy. But those are all risks that we don't know when they'll affect us or how they will affect us, but there needs to be a plan in place to address them if it does happen. So that's always part of the planning process too. And I think you really need to address those things. But if you add that together, you have your goals, you put your addressing those risks, and then, as we say here, that just makes for a very strong retirement plan, because you've identified your goals and you've identified the risks and how you're going to deal with them. So you're in a good situation to carry out that retirement income plan. As we look at the kind of the first risk.
Just to jump in there, thanks for answering that poll question. So we really see from you that healthcare risk is the biggest thing that's on your mind. So that's important. Longevity risk comes up next. And then finally, stock market risk. So all of those are certainly very important to account for.
Yeah, and we'll talk about those actually. That's good. The first, one of the risks we had up there, we just put that up there because it's so current today. It's public policy risk, and that's really just how that can, how we address certain situations, or what kind of situations come up. Certainly can affect your retirement plan. Certainly, COVID-19 is affecting people's retirement plans, and it'll probably affect it more even into the future, to be honest, because there's a lot of money being spent to help, through this time, but that's also has creating a very large, deficit in our budget. So down the road, there could be additional taxes, and we're anticipating that with our clients now. Just what are some scenarios that could be down the road? So that's one risk. The other one is longevity risk, and a lot of people worry about, are they going to run out of money? Are they going to outlive their money? And what the slide on the left shows is that for a couple age 65, and this is surprising to some people, and I think maybe some people have seen this, but if you're a couple today at age 65, there's over a 50% chance that one of you will be around at age 95. So your retirement income plan needs to, go on for a long, long time. And so you want to have a plan to address that as well. And then another risk is just inflation. Obviously, we all know inflation, but even a 3% inflation has the ability to cut your purchasing power in half in 25 years. So you want to be looking at ways that you can keep up with inflation. And then declining cognitive ability is just the fact that as you get older, cognitive skills diminish, and maybe you aren't making the same decisions, or even maybe more than that, maybe you need to go into assisted living or something like that. But those are things that need to be addressed too. And just risks that need to be identified, talked about, and have some kind of, plan around it. Another one we'll spend a little bit more time on, because I think it's what I've seen this, I guess, in my time, is probably a really large risk. And that's just the the sequence of return risk. And that's because of when you retire, what the stock market does really has a large effect on how successful that retirement is, unless you've done the right planning. So as you can look at this slide, you'll look at this. These are slides you've probably seen before, maybe in some 401k meetings at work or other places, but it just shows that over time risk does return in the stock market. You can see in the first year, there's substantially more risk in the stock market than there is in bonds or a 50-50 portfolio. That's in over any 1 year period of time. But as you look through the years and you go out over 20 years, you see that the stock market risk goes way down. The stock market being in green, you can see at 20 years, actually, it has less risk than bonds and the 50-50 portfolio. So time does reduce risk in the market. You just have to have that time to let the market work. And sometimes at retirement, we don't have that time. And we have an example next that shows that pretty well. So this is a slide that shows there's two portfolios, Portfolio A and Portfolio B. Portfolio A is on the top and Portfolio B on the bottom. And you put $100,000 in the portfolios. And if you don't take any money out, you can see that the returns that you're getting from these portfolios are exactly the same, but they're in reverse order. So at the beginning, Portfolio A has very good returns and Portfolio B has negative returns. At the end, you can see that Portfolio B, which is the bottom again, has good returns and Portfolio A has the negative returns. But because you had the time frame to go through that and you were not taking any money out, you actually end up with the same amount of money over a period of time. So let's think of that as during the accumulation phase. You put money in, you have the time to let go through it. Where it makes a big difference, and this is what we found out in 2008 and 2009, and actually I think some people made some knee-jerk decisions this year that may affect the same thing. But if you're taking money out of the portfolios, we have $685,000 in that portfolio. But if you start out with positive returns at retirement time, you can see that you end up with a very successful retirement. First of all, we're showing a 5% withdrawal on both account A and account B. So it's retirement time. We're taking withdrawals out of this pool of funds. And if you start out with good returns, everything works well. You can see that even with negative returns at the end, everything is good. The risk is, and it's important to really plan for this, is what happens if the stock market decreases in the early years. So in this case, you can see the market was down. And because we started out with negative returns and we were taking a 5% withdrawal out, you actually run out of money in 13 years. So addressing the sequence of return risk, and we'll talk about different ways of doing that, becomes really important at retirement time.
Great. So we've talked about some of the key risks, and one that we didn't talk about as much is just the healthcare risk, and that was a big interest for people. So there's different ways that one can look at that, both as part of the planning, and we'll address a little bit of that here, as well as through long-term care, and there's a lot of new and good ways to think about that. But for purposes today, that's not something we're going to be jumping into, but you're welcome to ask us those specific questions, and we can talk about that more in part 2 together. But this next section now, we're going to talk about how you address some of those retirement risks. Specifically here, we're going to talk about the income planning side. So there's a few different schools of thought when it comes to retirement planning, and this isn't something that, there's a lot of education about. But we believe it's really important that you understand these so that you can build the right plan for yourself. So you can see across the top, there's 3 different ones. I'm going to start on the left with a probability-based approach, sometimes called the systematic withdrawal approach. This is an idea often attributed to someone named William Bengen, which you don't need to remember. But this approach generally states that a 4% return is the amount you can safely withdraw from an investment. With this approach, we have our spending needs lumped into one bucket or one big diversified portfolio, and we look at the percentage that will bring us successfully through retirement. We're invested for total return, and we either succeed or it doesn't work. It isn't as worried about taking risk off the table or protecting against sequence of return risk that we've just talked about. If your goal is for maximum upside for your investments, or you're extremely focused on leaving a legacy, or you have a much larger net worth and you're not at risk of outliving your assets, then this might be a really great approach for you. However, what's missing here is that it doesn't protect against, like I said before, that sequence of return risk. This means that you may need to look at other strategies during a down market or even reduce spending during those down market years. And those, down years early in retirement can disproportionately hurt the sustainability of a retirement plan. The strategy also leaves longevity risk on the table, which was something that people had expressed, thought that was a pretty big risk, because the investment portfolio is now vulnerable to being unable to support the desired lifestyle for that full retirement period. And it also has susceptibilities to declining cognitive abilities, because you have to make more complex decisions as you get older. The middle approach there is the time segmentation or bucket approach. This was pioneered in the late 80s, and it is an approach based on segmenting retirement assets by time, as its name would convey. This is a great strategy to help you understand the different periods of time and how to match a portfolio for those specific time periods. It does help reduce sequence of return risk because money taken out in those earlier years are not as susceptible to sequence of return risk because they're invested more conservatively. This can often help you stay the course, and we see that with our clients. But of course, it doesn't have any guarantees in place, so it does have, a few risks that first strategy had as well. And then finally, we have the safety first approach, which is where you build an income floor to meet your basic needs. This means you look at your basic expenses, figure out the necessities of retirement, and find income sources that are safe. You could build this floor through things like pensions, Social Security, and other guaranteed income sources. And what's interesting is the safety first school of thought was originally derived from the academic models, looking at how people allocate resources over their life. Basic questions in economics is how you optimize in the face of scarcity. So academics since the 1920s have explored this topic, and most notably Nobel Prize winners Paul Samuelson, Robert Merton, William Sharp have explored these models quite a bit. And so where might each of these strategies fit for you? What are the advantages and disadvantages of each? One thing we do know is that people tend to be happier when they do have guaranteed income sources in retirement, just because they know they have that paycheck coming in and there isn't as much anxiety or stress. And new research shows that of 10,000 simulations, annuities can also help improve retirement outcomes compared to investments alone. So the basic idea is there's a lot of different options, and you really want to think through what's going to fit best for you. If we look at just again some of the research and what that says, we look at some work that was done by a Princeton graduate and professor of the American College, Wade Pfau. So what you see on the right is spending sources for two retirement income tools. The bond ladder supports spending through the spend down principle and interest earned on remaining principal. With the same assumption for interest rates, the income annuity also provides the three sources of spending plus risk pooling. And that risk pooling allows for 35% more inflation adjusted spending over this particular person's lifetime as they modeled it when you're planning for investments through age 100. So the question becomes whether the risk premium from the stock market will provide sufficiently higher risk for a diversified investment portfolio to sustain the same level of spending. So what we're looking at is, what does the research say between stocks, bonds, annuities, and other ways you can look at it. So what you see here is the premium used is 6% with a 20% volatility. The stock market returns are modeled at 9% growth with 20% standard deviation, so just the fluctuation from that. And what this shows is that a 100% bond portfolio can successfully match an annuity for a 20-year time horizon to age 85. But the bond portfolio will deplete before age 90, and at that point, success falls to zero. By 90, the annuity has reached beyond what bonds can accomplish on their own. And the exhibit also makes clear that for someone to consider the risk premium as a retirement solution, it's important to not be timid about stock selection, so to be invested more aggressively. And with planning of age 100, the best opportunity to do that is 100% stocks, which only has a 66% probability. That means 34% of the cases, the all stock portfolio will deplete before planning age when trying to match the spending protected by the annuity. So that's a lot of information. You don't need to remember a lot of it, but there's a lot of numbers behind how we make and look at what makes sense in retirement. So then if you think about, what is the best decision for you? With our clients, what we find works well is a combination. We go through our M Guidance retirement process, and often it's most effectively set up through a combination, right? Not surprising. So we look at income floor, Social Security, pensions, guaranteed income, and then we kind of incorporate a bucket approach for the rest. So you'll see along the top, you see 5 different buckets. So what we do is we look at what the spending needs are for someone, how much they feel comfortable having in, what's going to give them peace of mind as they move into retirement. And then we look at what the additional amount is above that floor that we need to supplement for the next 5 years, 10 years, 15 years, all the way out through someone's life. And then we invest assets accordingly, just again, to bring more certainty and reduce some of the risks that we've talked about together.
Yeah, just to kind of expand on that. So the bottom, the income floor is the first thing is, what are your guaranteed income sources? And then line that up against what you see as what your expenses are that we talked about early in retirement. And then there's a difference between the income floor, which would make up Social Security and whatever other tools you're using, and what your expenses are. And that difference then, the first 5 years of it would be taken care of it by bucket 1. And what does that do? Well, the bucket 1 is a low risk bucket, so that if we have a market that goes down, the sequence or return risk will not affect your portfolio. You can feel very good because you know that those dollars are there and they're not at risk. But then as we forecast that out, you can see that bucket 5, that's the dollars you'll be using, 15, 20 years from now. Those dollars, when you see the market go up and down, you're okay with that because you're not going to be using those dollars, for a number of years. So it really protects against the sequence return risk and actually just helps people sleep better at night.
Mm-hmm. So that was a lot, but that was really our part 1, looking at what all the risks are in retirement and just starting to touch on some ways that you can think about and address those. So in part 2, what we're going to go more into is tax efficient distributions and hidden tax penalties and how to think about what those are for your specific situation.
Yeah, that is a lot. We talked about earlier the risks, and then we, as we go through this, but as you look at managing your taxes in retirement, it really becomes critical. As you know, your retirement plan, your assets at this time are probably made up of taxable accounts. That's your non-qualified accounts. Your tax deferred accounts, generally those are your IRAs or your 401ks. 403bs, things like that. And then your tax-free assets. And that may be you have some money in Roths IRAs, Roths. But the way you combine those and take income out becomes critical at retirement time to minimize the taxes that you pay. So we have a slide here that's titled Tax Allocation. And you hear the term asset allocation all the time, right? What is my asset allocation? How much money do I have in equities? How much money in bonds? How much is international, large cap growth? But along with that, tax allocation becomes critical at retirement time. Well, actually, even before that, during the accumulation stage, because as you look to put together a portfolio, you want to make sure the investments you are making are in the right tax bucket. For example, your taxable accounts on the left, each year you got to pay tax on those accounts. So we want to make the investments we put in those taxable accounts as tax efficient as possible. We want to, with stocks, we pay capital gains. We don't pay ordinary income. Municipal bonds provide tax-free income. When we say tax managed funds, we just mean that managers that are set up so that gains and losses are offset against each other through the course of the year, so that at the end there's a lower tax cost. Take advantage of gains and losses where they come up. But the point, I guess, is those are the assets that are the most tax efficient and really belong in that taxable account. And then we look at the tax-free and the tax deferred. Now, you may say that you want 40% in bonds and 60% in equities, and that may be the right asset allocation, but where you put those assets is important. So let's have the bonds in the IRAs, the tax-free accounts. because you don't pay any tax during the accumulation of those accounts. So if you have a taxable bond, for example, it'd be ordinary income if it was in your taxable account, but it's inside your IRA, so there's no tax to be paid. Now, when you take the money out, you'll have to pay the tax. So that becomes another step in making this tax efficient. But we just want to make sure that the assets are owned in the appropriate buckets. And then what this slide shows is that just an example of the way a portfolio may be set up for somebody. Both spouses have $700,000 in their IRAs. They have money in their Roths, and then they have their taxable accounts. But as they take money out of these accounts, the money coming out of the IRA is all going to be taxable. So you want to maybe take that out in low tax years. Once again, getting back to that after-tax net worth is really what's important. Maximizing your after-tax net worth. The Roth IRA comes out tax-free. So, in years that you have a lot of income, maybe you take money out of the Roth if you need additional income, because that comes to you tax-free. And then your taxable account, you manage that for tax efficiency. But sometimes the common thought is that, I'm going to wait on my IRAs till we have to take money out, the required minimum distribution. And that's recently went from 70 and a half to age 72. So the thought was just leave the money in the IRAs and let that accumulate till age 72. If you can do that, if you don't need to spend it for income up until then. But the problem with that is it continues to grow, and then you have to take it out. And there's an RMD, required minimum distribution. It may throw you in some very high tax brackets. So for a lot of our clients, it's important to level that income off through the early years of retirement too, by taking some money out there just to keep them in lower tax brackets. So the levelizing of income, combining with low income years, maybe because you've done a write-off, a donor advised fund, a larger charitable gift, you can take more money out of the IRAs to supplement it. But the way you spend these dollars can make a huge difference in how much money you have at retirement time. Another thing that we're looking at this year, and you've probably heard of it, Roth conversions, and that's simply it sounds kind of expensive when you first say it, but long term it can be a very effective strategy, because what you're doing is you're taking money from a traditional IRA, could have been from a 401k that was rolled over into an IRA, and you're converting it to a Roth. Remember, Roths, the money from a Roth comes out tax-free. So that's great income at retirement time, tax-free income. But to do that conversion, when you convert from an IRA to a Roth, you need to move the money out of the IRA and put it into the Roth. That creates a taxable event. So that's where the cost comes in the first year. You pay the tax on the conversion. Once you've done that, then it's tax-free income from there on out. So it's not something you do because it's going to make you better 1 or 2 years. It's something you do for a 20-year strategy. And sometimes we combine that with, donor advised funds or some way to get a write-off so that income isn't quite as big that year. So it's a combination strategy many times, but once it's done, it grows tax-free. So it's something that I think every client we have this year, we're kind of doing an analysis to see if some amount makes sense.
So Bob, we had a question from someone. Does a Roth conversion have the same RMD requirements as a traditional IRA?
No, that's another advantage actually. When you do a Roth conversion, that's a great question. When you have money in Roth IRAs, you do not need to take money out of those at age 72. There is no RMD requirement. So that's something that you can actually defer that. It's a great asset to pass to your children actually, because it goes to them tax-free as well. But no, there is no RMD requirements on Roth IRAs.
Okay, great.
Should I back up and talk about RMDs just a little bit, just so everybody understands what they are? I don't think we've spent enough time.
I think high level that might be good before we jump on to the next section.
Yeah, an RMD, and I'm sure a lot of you are familiar with it. Maybe some of you are not as much, and sometimes we take that for granted. So, but when you have a qualified plan, you need it. You can defer it, but at age 72, you have to start taking money out. And basically, if you wait till age 72, it's at about a 5% rate, and then it's basically a life expectancy. You have to take out more each year as you get older. But it's a required minimum distribution in IRAs, so you can't defer it forever. Is the point, I guess.
And what you might have heard, you might have had that 70 and a half stuck in your head. The Secure Act, which we're going to be talking about later, actually changed that age and increased it. And so it has now changed to 72. So that allows for more planning opportunities, allows for potential Roth conversions as well, after work, but before you have to start taking RMDs. So really, any questions on your specific situation, we're happy to talk about more in part 2 when we go through that in detail.
The other thing important about RMDs this year, and we're doing it with a lot of clients, because sometimes people don't want to take money out. Part of this Cure Act is you do not have to take RMDs out this year, even if you're over age 70 and a half or 72. In fact, we've had clients that were taking RMDs and they're putting them back in their retirement accounts because it reduces their taxable income. But that's a strategy that, so this year there is no RMD requirements. It'll pick up again next year again.
And that's the same for older inherited IRAs as well. There's no requirements there. So that's a lot. So now we're going to jump into just 2 specific hidden penalties and that often get are confusing or don't even get looked at when it comes to taxes. And poor choices through not understanding these things can result in significantly more taxes than necessary. So don't worry about understanding the details of them. Just remember that they exist. So the first one is something we call, it has to do with Social Security. So this is an example of Bill, who's been working, most of his adult life. He has an income of $42,475 in taxable income, which includes $25K in Social Security benefits this year. He's in the 22% tax bracket. Towards the end of the year, Bill decides to take an extra $1,000 out of his IRA. So immediately you might say, hey, that means it's just going to be taxed at the 22% tax bracket, $220. We're ready to go. But the way that what actually happens here is that additional $1,000 of income increased his AGI and taxable income by $1,850. That means every dollar of income he actually received, he's being taxed at 1.85. How is that possible? Here's the deal. Depending upon how much income you have, the amount of Social Security benefits that are taxable varies. For instance, if your other income is low enough, your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is higher, it'll be taxed at 85% of your Social Security benefits become taxable at whatever your personal rate is. And so Bill finds himself in the later scenario here. At his current income after the trip, for every dollar he takes out of that IRA, he not only adds $1 of IRA money to his taxable income, but he also must add that additional amount of 0.58 cents for the taxable Social Security benefits. So that's a 40.7% real tax rate on just that additional $1,000. That's a lot, and just something that you want to take into account because it might matter for you. Another one, sorry, I think I went ahead there. Okay, so another thing to keep in mind here is just new challenges that can come up after the death of the first spouse. So here, sometimes this doesn't get planned for or accounted for. So sometimes, there's the loss of the larger standard deduction, higher tax brackets for single filers, questions about the Social Security income that someone should take. So it's really important to make sure that you account for different planning opportunities if one of the spouses should die quite a bit earlier than the other. And then the next piece here is on Medicare. So Medicare sometimes gets forgotten, but it's called IRMA, and it stands for the Income Related Monthly Adjustment Amount. So the additional amount that you have to pay for Medicare Part B and D. And the emphasis is on income because it's a monthly tiered surcharge that is tacked on to people's Medicare Part B and D premiums. But it only happens if your income is over $87,000 if you're single, or $174,000 if you're married. So what that actually means here, the example is just Martha and Mary. They're a high earning couple. Both are taking Part B and D. They're participants. IRMA surcharges, if you remember, are affected from 2 years prior. So that may be something you don't know, but that's how it's calculated. And this couple was on track for $267,000 of modified gross income in 2018, but they decided to sell just a $1,000 stock that was a stock that's going to, give them a $1,000 gain. So what happens? Remember, by definition, the tax increases as your income increases. So here, what happens to George and Martha is even $1 drastically pushes them up to the next bracket. So now they're actually paying $2,500 more, just because that cliff, that $1 more, put them over the edge. So if you're, way over, it's maybe not something to consider, but just around the edges, it can matter. So that's something that's known as the IRMA tax cliff. And again, just something to be aware of so it doesn't, surprise you. So then the question becomes, what are ways you can reduce taxable income because of the Social Security or because of Medicare? And there's a lot of different ways that you can think about doing that. But a few here are just distributions from Roth IRAs or 401k accounts, withdrawals from health savings accounts, which are just such a great tool to start early on. Withdrawals of cost basis or loans from life insurance, direct contributions to QCDs, and certainly a lot more depending on your situation. But that kind of jumps us into another opportunity, which is around charitable giving.
Yeah, thanks, Carrie. For a lot of you and a lot of our clients, charitable giving is just part of their plan each year. And there was a change in the tax law that, the standard deduction was increased. And we're going to use an example here of Albert and Shirley, but their standard deduction now is $27,000. They had $13,000 of existing itemized deductions. So that's, interest and just different things. And then they had, they were giving $14,000 to charity, but with the new laws, starting last year, there's no write-off for that additional $14,000, which, it's fun to give money to charity, but it's fun to get a little tax benefit for it too. So that's kind of a big deal. So there's ways of doing that, ways around that maybe there's another way they could pay their charitable giving with different strategies. And so here's an example of maybe the way they were doing it before. This may not be it, but let's just use this as an example. They had an IRA. They took $14,000 out of their IRA, put it into their checking account, and then they gave that to charity. But of course, that $14,000 they took out of their IRA, they had to pay tax on it. So really, they needed to take out about $18,000 to have $14,000 to give. So, and they get no write-off for it. That $14,000 now is because of the new rules. There is no write-off, and that was also came out as an RMD. So that was a required minimum distribution. They needed to take those dollars out. They didn't need them for their standard of living, so they thought they'd use it to give to the charity. But here's another thing that we do quite a bit of, actually. It's called a qualified charitable distribution. We use the term QCD, but it means qualified charitable distribution. And in this case, you have money in an IRA, but you give it directly from the IRA to the charity. And once again, we're all centering around here is what's the best after-tax way of using your retirement income. So this once again goes right back to that point that the $14,000 now goes directly to the charity, but it's included in your RMD. So it is part of your RMD and it satisfies your required minimum distribution. But the beauty of it is it's not included in your taxable income. So you're taking $14,000 out of your IRA, which will not be added in for your income. It satisfies the RMD. The tax bill is zero. So even though we're not getting a tax deduction, we're also not paying tax on the dollars we're taking out. So it's a very effective tax strategy to use at retirement time, and a number of our clients do it. Another way of looking, so we got that on top here. Here's some other ways to kind of work around that. Once again, the standard deduction is pretty large, so you have to be giving large amounts to get the write-off. So QCDs, or qualified charitable distributions, is one way of doing it, but another way is using donor advised funds. So just a quick example, let's say that a person's giving $10,000 a year to charity. So over 10 years, they'd be giving $100,000. That's just part of their plan. They're giving $100,000 over a 10-year period. So that $10,000 they're giving probably they probably don't get any write-off for it now with the new standard deduction. So a way of doing that is, why not bunch all that giving into 1 year if you have the ability? And if you're giving $10,000, maybe you probably do. You take an asset, hopefully some low-cost basis stock maybe, but even if it's not that, you put that into a donor advised fund. you get a write-off for it now because it's a $100,000 gift to charity. You get a write-off. It's well past the standard deduction, so you're getting a nice write-off. And then each year, it's your fund, it's your donor advised fund, it's your bucket of money. Then each year you can decide if you want to give that to charity or not. But in this case, let's just say you're going to continue giving $10,000 a year to your favorite charities. So you've accomplished the same thing, but you have got a nice write-off by just bunching your gifting together in 1 year. We've had clients doing that, and they're already bunching again, this year for some. They bunched 3 or 4 years ago, and they're doing it again just to get the write-off, because they're making some gifts to charity. So it's a great tool to use to take advantage of getting some write-off for those gifts.
So we've talked about a lot. Now we're going to bring it all together, and I promise the section's a little bit shorter. But before we jump in, just a question. Do you feel like right now you have a good retirement income strategy? Just curious where everybody is coming from. So you can go ahead and answer that. And while you do, we're going to jump into the last section. And what you'll see on the right-hand side is those handouts now. You're welcome to have as reference. They'll be there, but some of the things we're covering are covered there as well. So there's been a lot of different tax acts that have been passed. And one of the, kind of the first of these three is the Tax Cuts and Jobs Act. And that had 20 significant changes to the code, and we've organized those into basically 4 key pieces. The first one is about the loss of many well-known, even beloved deductions. And of course, the change in the standard deduction from, $12,700 to $24,800 for married filers. While eliminating many miscellaneous deductions. And so that's why all the planning pieces, the looking at more efficient charitable giving, looking at other things is more important than it's ever been. The second piece here is just that the unique situation faced by residents of certain states. There's key differences, between how you're taxed based on whether you live in Florida or Minnesota, for example, from an estate and income tax perspective. The third is about the family issues and taxes. So in Q3, we look at things like now you can use 529 plans for K through 12 private education up to $10,000 a year. Alimony is no longer deductible for the payer, nor is it considered income to the payee. The top rate of 40% on the state taxes is over 11.6 million for individuals compared with 5.6 in the old law. And then finally, there's some important changes to the rules for businesses, especially small businesses. The corporate tax rate changed and the new QBI deduction was implemented, which there's so many different planning opportunities to just, if that applies for you, if you have a Schedule C, to really make sure that you're understanding. So again, you have that handout to reference those, but we encourage you to really take some time to make sure you're taking advantage of everything you can on that front, or talk to your accountant, or we can talk about it more with you in part 2. So the next act that was passed in late December is the Secure Act. So the key points here, we're not going to go into all of them, but one of them is, businesses have more incentives than ever to create retirement plans for employees and promote participation. We're not going to go into this in detail because this likely doesn't affect you right now, or isn't going to for a long time. But the second key point we've already referenced, and this is having more time for retirement and more ways to save and more ways to use those funds. One of the biggest changes there is that change of your required minimum distribution from 70.5 to 72. And there was also an opening of some additional ways to recontribute to retirement plans. And then the final point here is around really impacting estate planning. So this is around IRAs that you hold that you plan to pass on to your children. So you can still pass an inherited IRA to your kids, but they have to take it out within or at the 10-year mark. So before that, they had, potentially 30 plus years to take out their own required minimum distribution every year over their lifetime. But now that has to be taken out within 10 years. So if you have a big IRA, and you have a successful kid, that's going to be a problem that you want to account for. And there's a lot of planning implications that you can take into account there. We have a new client that came to us who has this exact problem. And so there's a lot of planning we're doing around it, but it would have been great if we could have helped her dad out before that, so that there would have been some different opportunities specifically for her. So as you think about that, how can you bring it all together? There's a lot of different pieces here, but really this is just a quick review of the different stages of retirement and almost a checklist that you can think about. So under the pre-retirement heading, we saw the importance of understanding the after-tax value of retirement savings before you retire. We also saw that in those pre-retirement years, it's important to understand your tax-deferred savings and start taking advantage of Roth accounts, to fill different buckets. Something you'd be doing through potentially the early retirement years when you have lower taxes as well. We also looked at Social Security and taxes, and a piece we didn't talk about, but is just optimizing when you take that Social Security. So that's something in part 2, we can give you your own report so you can really understand that. Plus
Boy,
the
that's
importance of,
very just optimizing Social Security. We've seen that
yeah,
so many times that there are different options that can make a big, big difference on how much money you actually take out.
yeah, it's a big deal. We saw the Medicare in Irma Cliff, and making sure that you understand those pieces, because in the middle years, that's when you have to think about things like RMDs and the importance of planning those and understanding the taxes before issues start to come up. And then finally, the importance of setting up your assets and managing them during those later years so that you can preserve the most for your heirs and leave them with the most taxability. And again, what we've seen over the last year is that planning really matters, and it can make a huge difference in your life and your ability to sleep well and know that you have everything accounted for. So we're not going to talk a lot about this slide, but these are things that we've been doing in detail with our clients over the last 6 months, and really the specific timeliness of some of those based on, markets, based on opportunities, based on not having RMDs this year, making sure that your estate planning really is up to where you want it if, anything unexpected were to happen, making sure you have an emergency envelope available in a way that anyone can access information if something with COVID hits you. So it's just making sure, again, that all those specific bases are covered. So that brings us to our last slide, which is really just covering kind of, today's been a lot. We talked about a lot, and we really want to acknowledge you for taking the time. It's a lot of information, and the goal was just to introduce you to concepts. And that's why afterwards we're going to call you. We're going to answer any questions you have, and then give you the opportunity to schedule that part 2. And so we can go more in depth into how all of these specific parts that we've been going through today impact you. And that's where here what you really see is just what that agenda is for the second meeting, so you can really make sure that you're covering your bases and preparing yourself well.
Yeah, I'm just Carrie, if I could just say something at the end too. I don't think I've ever seen a more important time because of the changes, the possibility of suspending RMDs, the charitable giving. I've never seen a time where planning and looking at things in a holistic, with a holistic mind is more important. To put together a plan, a good retirement withdrawal strategy plan, so you keep your taxes in the lowest tax bracket possible, so you maximize your after-tax retirement income. I've never seen a time where there's so much there right now, and to optimize all those things, I think is really it's critical. And so we'd like to thank you for your time. I know, Carrie, you want to say a few things to tie up.
Yep. Yeah, I just said, as we said earlier, we'll be calling each one of you within a couple of hours to answer those outstanding questions. And in that part 2, we'll also give you that Social Security analysis if you want to schedule time for that now, or we can do it on the phone together. But really just want to thank you for your time, and we'll talk with you soon. Give you a few minutes back to your day. Take care. Have a great day.
Thank you.